the volatility over the last roughly 6 months. What is this saying about retirement planning going forward? And then we're going to jump into Social Security.
That's a really great question. And we get this sort of discussion occurring on a regular basis, particularly when there's short bouts of volatility, say a week, a couple weeks or so, and the market tends to freak out a little bit. But then, especially when it extends about, say, 6 months or so, and typically the best situation to approach it is really bringing things back to the basics of long-term planning and long-term investing. When you look at the history of the market, we've seen these kinds of ups and downs for short periods, for long periods. And when you look at the numbers, it's staggering to see how when investors make maybe short-term moves based on some short-term volatility, they tend to be out of the market on key days. Typical phrase you hear a lot is until I feel comfortable getting back into the market. And unfortunately, when people feel comfortable is usually once the market has come back to where they were and even above. And then they're thus doing a never-ending cycle of buying things that are expensive or high and selling out when they've already gone down. So we typically suggest to keep that long-term view, even in retirement. So even as a quick example, sometimes folks might believe that they should be in all cash or something extremely conservative the day they hit retirement. But when you look at it, if you say, for example, retirement is age 65, a lot of people will live 10, 15, 20, maybe even 30 years in retirement where they need their money to last. So they definitely need something that can add some upside to it. My grandmother, for example, is going to be 102.
Wow.
August. Yeah. So you got to plan for things like that.
Yeah. My dad's going to be 93. So yes, planning is key there. And we could talk about the 4% withdrawal on your investments, leaving them in some in equities as we go forward. But I want to talk about Social Security. A lot going on right now. And we set up with the bond route. And I realize the 20-year is something that people don't really pay attention to until you can't sell it. And the reason I bring it up is because Social Security is one of the issues that gets batted back and forth in Congress. And there's this vote on the reconciliation bill that's going to be coming up. But at the end of the day, because it gets very complicated, but the issue is U.S. government debt. And how are we going to cover future payments regarding Social Security? And in the first part of the stream, I pointed out that when people say Social Security is bankrupt, that's just not true.
Right.
On its current trajectory, the trustees have told us that it's not going to pay 100 cents on the dollar, but it's not bankrupt. So in a worst case scenario, on the last trustees report, 2024, it would pay 83 cents on the dollar. Now, that's not good, but it ain't bankrupt. So let's talk about Social Security. It'll be there. It's going to be there for a lot of Americans, and hopefully Congress will get its act together and fix this. How do you determine the age to take it? Because you can 62 or 70.
You get a dartboard and you throw a dart at it. No, sometimes it feels like that, actually. When to take Social Security can be sometimes a very simple decision, or it can be really complicated, depending on your personal situation. It's probably one of the most personalized decisions in retirement planning and income planning in retirement. And so when to take it, it's there are so many factors. Some of the key things that people tend to look at and tend to influence when someone takes Social Security, it can be very basic, either kind of a barbell effect. Sometimes it can be, okay, I've got so much money saved that I literally don't need any of Social Security, and I'm going to leave it there and get that extra boost of 8% per year. And once I can, from full retirement until age 70. Or the other end of the spectrum is someone maybe doesn't have a job and they absolutely need every penny of that Social Security as soon as possible. And then there's a whole lot in between, which is where a lot of people land. So when to take Social Security, one of the best things that honestly can be done is at least reading up a little bit on Social Security and some of the factors that are involved with it. It's different factors from maybe an individual. They might be single, so they're just looking at their own circumstances, or a married couple. Then there's other factors of, okay, if you're a married couple, did did both spouses pour into Social Security long enough to get the full benefits? And there's a big waterfall of other factors to consider, because it can be so complicated, and because you really can significantly increase your Social Security payment if you can get the strategy just right, and if you can hold off for a certain amount of time. It really can be beneficial to have some assistance from a system or a tool or advisor.
Yeah, but I want to also point out, though, a lot of people, for instance, I'm going to use myself, forgive me, I am a little bit of a narcissist, or self-centered. Narcissist, not true. But look, I was on TV. You can't be on TV and not be self-centered. I set up our retirement based on pushing out Social Security to the max, if God willing, I live that long. But here's the deal. I don't know what Congress is about to do. So if I were setting this up again and I was talking to someone in their 30s and 40s, I got to imagine they're thinking, how do I plan for retirement? Because I don't know what Congress is going to do. What they're going to send my way may not be what I'm expecting now. So why make plans with Social Security as part of it, since that might be a diminished return? And we should point out to our guests, David Montgomery helps companies set up retirement plans. So he understands this stuff. So what do you say to that 30 or 40-year-old?
Yeah. So what I would say to them is for them to really look inward at their risk. They're not risk tolerance, like a risk questionnaire or something along those lines, but how much do they want to depend on Social Security being there at the current rates? Mm-hmm. They are banking on the money being there at the current rates. That might be pretty risky. So probably the safest bet would be to not consider it to be there and save as much as they can. And if Social Security is there, great, that's icing on the cake, and they've got a better lifestyle in retirement. The other end of the spectrum is if they, again, bank on as much as possible in Social Security, and they save the minimal amount to get to retirement income that will include that full Social Security benefit. So I'd say probably go in between.
Yeah. David, you're helping me set up. I'm just going to tease for the audience that we have a guest coming on after you, Carol Roth, because the U.S. government, Carol's going to help me go to town on, there's a Yiddish word which I love to use, fakakta. What kind of fakakta planning is that? You know it because you live in Tampa. But look, it means what it sounds like. Carol's going to be joining us in about 8 minutes. But getting back to your specialty. So I am a believer, because I've lived it, in the long-term investing in equities. But then you get a day like we had today, driven by the bond issue, which is tied to the U.S. government debt issue, which Social Security, even though it's funded through our payroll taxes, is a whole other issue. How do you plan, if you're going to use your 401k for that investing, in this kind of volatility, especially since the 401k was never intended to be your sole retirement income?
Yeah, that's it. So there's a variety of methods to go about it for planning for days like this. A very simple, easy one. Let me back up for a second. So if you're someone in your 20s and 30s, you're going to weather this storm. You're not going to need this money for retirement for decades. So no big deal. Don't look at your statement. Just move on to kind of keep it short. And if anything, when you see downturns, that's an opportunity to buy things more on sale. If someone is coming up to or in retirement, that's where days like this are much scarier and much more potentially impactful, because they could be taking withdrawals on a down day where their portfolio has really decreased. In the 2008 recession, I literally spoke to people that looked for assistance a little too late and were crying, like literally crying their eyes out, because their portfolios went down 40% and they were supposed to retire, and they couldn't do anything about it then because they couldn't wait it out. So getting very practical on days like this, if someone is in that area where they don't have the time to weather the storm, that's where a variety of methods, there's bucketing, there's other different ways to do it. But a key way would be, in that overall planning, have part of your portfolio for that longer term time. And when you're needing to actually take withdrawals from your accounts, possibly have that aside where it's not going to be impacted by these ups and downs.
I interviewed Ted Benna, who was the man who is the father of the 401k, discovered the tax benefits back in 1978 because they had changed the code, and it's line 401k of the tax code in 78.
Right.
That's where it comes from. He said the greatest thing about the 401k program, and he doesn't think it's a good sole retirement thing, but he said it's a savings plan. And to me, is it still, if your company matches, it's the best, for every dollar you put in, if you get, let's say, 2 or 3%, that's 2 or 3% you didn't have, and you don't have to worry about volatility. Is that still the biggest reason to do the 401k, and if you can, max it?
Oh, absolutely. That is free money right there. I mean, let's use an example that a lot of employers do: dollar for dollar match. You put in a dollar, they put in a dollar. You put in $1,000, they put in $1,000. If you look at it as in terms of returns, if it was a return, that's 100% return. Most people would love to look at their statement and say, ooh, I got an instant 100% return. Now, it's obviously not returns, but on that certain money, there is that exact match, whether it's dollar for dollar, 50 cents on the dollar, or whatever that formula is. But at minimum, saving, if you don't go over the match that a company gives you, at least going to what that match is, because that's free money right there.
Well, I'm going to ask you the personal question. Don't give away your age. But what keeps you awake at night when you think about your own retirement planning?
Ooh, you know what? It's what I believe most people struggle with, and that is all the things pulling at our finances. No matter how wealthy or the opposite someone is, everybody has pulls at their finances and what they might want to or need to spend it on. So that's a big thing: is balancing the saving for retirement, the college savings, the general budget, and eating necessities to the toys that we want.
Yeah. So that's not $30, only $1 now.
Right, just $1 this time.
Right.
Exactly.
Well, let me ask you this, because you design the plans that a lot of us in the corporate world who have access to 401ks, you help companies design the plans to best serve their employees. Are we going to see changes to these plans? What's coming at us because of the volatility, or just because of other things?
Typically because of volatility in the retirement plan space, you don't see many changes to the investments in the plan. Because most employers have that long-term view, a lot of times they'll have an official process that they need to follow according to ERISA, which is the law that governs 401k plans. You really need to have a documented process for selecting and monitoring the investments. And with that, many times they'll look at investments and put it on something called a watch list, and keep it on there for sometimes 3 or 4 quarters or so before removing it, because funds do go in those ups and downs and tend to weather storms, and they look at the long-term view. Now, what could happen more likely is if there is an extended economic downturn and the company goes into some financial difficulties, well, that's where the company matches are usually the first thing to be reduced or go completely. In 2008, we had, if the company didn't go under, then that was one of the very first things they said, I'm sorry, guys, you've got a job, but no match, a company match. Which would you rather have? So they said the job, clearly.